All right.
We're here. We made it.
Episode 25. All right.
Yes.
And I think we've got audio, we've got video. All right. I'm super tired, but we're going to get this done. I was at a panel this morning hosted by Nashville Health that Senator Bill Frist and Mark Yancey, who's the president of that organization, pulled together. It was a really good event. And I think probably the thing that's most worth noting is the panel I was on, I was talking about health disparities. It had, so Mark Yancey, who's the president, he was the moderator. It had the CEO from the Healthcare Council.
Yeah.
It had April. It had Fahad, who's the CEO of Ascension St. Thomas.
Yeah.
Myself, and then Laurel Grafey, who is the regional executive for the Federal Reserve Bank for Nashville.
Oh, interesting. Yeah,
which made me feel so much better about us constantly talking about the Fed.
Yes.
To have a representative from the Fed on a panel talking about health disparities.
Yeah.
That was very cool.
And we've been studying it and talking about it.
I felt pretty up to speed.
Yeah.
I felt pretty up to speed. And we're going to do more talking about the Fed because, sorry, folks, that's actually what is driving all this shit.
Yes.
But we promised the audience we were going to recap some themes. Now that we're, a quarter of the way to 100 shows, what have we picked up as high-level organizing themes, maybe both of our conversation as well as the way that we have viewed all of the different articles and stories and press releases and different data points that we've been reviewing for 24 episodes?
Yeah, I mean, I think that the idea was that we just started this because we wanted to learn about it ourselves and kind of talk about it out loud. And a decent number of people have been excited about listening, which is wonderful. But after 24 shows, it felt like a good time just to take a step back. What have we uncovered over the last several months? And what can we take from a high level insight? And then should we change what we're focusing on in the future in any way?
Yeah.
And so I don't know. It feels like there's three maybe main things that we've been talking about. You mentioned the Fed. I think the kind of the macroeconomy environment. When we all sort of feel this post-COVID, I think the world's different after COVID than what it was before, and it's a little bit harder to define sometimes. But that is kind of categorized under macroeconomy, Fed, the employment, the rates, all, how it all fits together. And then we've been trying to cover that to understand it because it really affects our venture business, but it really affects the whole world.
Yeah.
And so that probably the first theme is that the macroeconomy forces in the marketplace are really applying pressure to healthcare, and it's driving change, and it's really catalyzing and kind of pushing the existing healthcare industry to get better or get out of the way.
Yeah, I think that framing it up around COVID is important because even before the Fed took action, COVID was the main player, I think, in an acceleration of changes that were already talked about coming and happening, but everyone always said 7 to 10 to maybe even 15 years, right? Nobody felt that they were going to happen as quickly as they did, but COVID absolutely accelerated them on many fronts. And we can talk about the impact that COVID had on healthcare workers, especially nurses, as a huge one. We could talk about what the shutdowns as a response to COVID spreading, what kind of havoc that created on the economy. And then we get to the Fed's response to that. We get to the stimulus.
Right.
And then we get to the Fed's response to the Fed's response.
Right.
Right.
Right. Yeah. I mean, I think that, it was a global crisis and a healthcare global crisis. And so I think it's hard to Monday morning quarterback what happened as far as stimulus from government and from the Fed at that time. And that is what it is. A lot of stimulus that happened. Maybe it was the exact right amount. Maybe it was too much. Maybe it was probably not too little. But there was something had to be done. And that drove everyone to start spending money. And our supply chains were not ready because of COVID. And so you had kind of a supply chain driven shock that drove prices really high really quickly. And whether it would have been transitory or not, I don't think it really matters. It wasn't going to resolve quickly enough. There was a lot of pain with inflation. Causes a lot of pain to people that are less well off, that can't afford it. Because when your gas bill is going up and your food bill is going up, people get really upset. And so the Fed reacted to that, and we're still in that situation now.
Yeah,
where the prices have come down significantly, but not back to the pre-COVID levels. And I think that's going to continue.
Yeah, and there was also a lot of really weird behavior that was started as a result of the stimulus. Some of it individuals, from an individual spending perspective, and some of it companies, right? Stimmy checks weren't just for individuals. We have PPP, we have EIDL. These programs, I think, really allowed organizations to operate without profit as the prime motivating factor. I mean, in many cases, PPP and EIDL made companies profitable.
Yeah.
Many companies were made profitable via that. So,
and the Fed started buying mortgage-backed securities and company bonds.
Yep.
And that when emergency break this glass, we broke every glass and did all the stimulus we could do. And maybe we needed to do that. But it's difficult to come back from that. The population got used to getting stimmy checks and getting unemployment forever at sort of extra rates. And then, yes, there's a lot of corporate support. And then we had the, interestingly entitled Inflation Reduction Act that didn't reduce much inflation, spent a lot of money. And so it continues today. And it's hard to, once you break that glass, it's hard then to go back and not, unwinding all of these functions is much harder than pushing the money out.
So let's talk about specific to healthcare. What are the ways that you believe this combined event of COVID and the Fed's response, how do you believe that impacted healthcare? I think we can talk, for one, we can say there were a lot of healthcare workers that may have been on the edge anyway with their satisfaction with the career, with their satisfaction with work-life balance, with their satisfaction with their earning. And for many of them, we have to say the relationship between many of people in the general public and healthcare workers became an antagonistic relationship, especially once vaccines came into the picture. There was distrust. There was all sorts of confusion around the way that the vaccine stuff was messaged. There was just the sad reality that in order to try to contain the spread, many people weren't able to say goodbye to their loved ones. Right. So it was just a fraught time. It was a very, very bad time for a lot of reasons. And I think to expect that would not have created broad trauma across the base of healthcare workers. So certainly, doctors, but nurses are frontline in all of the hospitals, and hospitals were really where this stuff was all going down. It makes sense that nurses would have a fallout as an overall sort of industry, as an overall workforce component of healthcare, based on just their lived experience through the COVID-19 pandemic.
Yeah, there's no question. Listen, I was in my house on Zoom, still pretty functional in my job.
Safe.
Totally safe. And nurses and other healthcare workers and doctors had to get in their car and risk their life and go out and take care of people. And that's their calling. And they deserve a lot of credit for that.
And then we just need to say, remember, they would go to work, risk their life, and then go home and potentially be risking their family's lives.
Yes, right. And then for reasons that made sense at the time, we weren't allowing visitors into the hospital rooms, and the nurses and the staff who are not paid to do this job had to be like bouncers and security guards, preventing people from entry to see their loved ones in a very scary, emotional time. And so all of that was going on.
And in many cases, they had to be a surrogate or a substitute for the loved one at the time of someone's passing.
Right.
Which is massively traumatic.
Yes. Terrible. And so that was a thing that was really put a lot of pressure on already a challenging job.
Yep.
And then we had inflation, which was not the fault of nurses and health systems, had nothing to do with them. But for the reasons we just said, stimmy checks and the government and the Fed trying to keep the wheels of the economy going, a lot of money was sent out and people spent the money. And that drove the cost of living up dramatically. And health systems have mostly fixed revenue line items. So their reimbursement is set largely by the federal government. And then, yes, there are commercial payers, but they're all tied to what CMS does. So effectively, they're locked in. They can't raise prices. And so there became this tension where restaurants and other retail establishments, once the vaccines came out and you could move around the world again, they started paying people more because they can change the prices and reset what they pay workers for the environment. And health systems and other healthcare organizations really don't have that flexibility. And so this combination of a really hard work environment getting sort of exponentially worse, more work, harder hours, more effort, and then much more fraud emotion. It's always a hard job, but it got much worse. Combined with now I can't afford, I wasn't getting rich to start with, and now I can't afford to fill my car with gas, or I can't afford to buy enough food for my family. It created this massive tension between the workers and management didn't really have the levers to effectively solve it. And so that's sort of the macro environment that I think COVID caused. And we're still trying to unwind that today.
Yeah. And then I think there were also, there was a battery of different emergency measures that were put in place. There was also emergency funding that was put in place to sort of help get the healthcare industry across this, across this valley of despair and unknown. And then those things ran out. Right. And when they ran out, it didn't mean that the healthcare industry was on solid footing when they ran out. When they no longer reimbursed for telemedicine, or when they stopped delivering health systems, stimulus checks, didn't mean that they had fixed their business at that point, or they were ready to sort of go the other way. So I think that was another point of impact that it kind of took an extra 12 to 18 months for many health systems to actually get back to where they were from an operational perspective after those emergency measures were taken away.
Yeah, I think we are seeing today, a couple of years after all these events. CMS changes the reimbursement rate essentially once a year. There's a couple updates and things, and so the rates for this year are much better because inflation was high last year. Maybe inflation is coming down slightly, and perhaps the healthcare industry can catch up a little bit, hopefully. But there's a lot of pent-up need there. And we talked about it last week with Kaiser. There's still this tension between management and workers. And Kaiser happens to be sort of an integrated system with the payer and provider all connected together. They're well run and pretty healthy financially, but a lot of health systems are not in that position. And so there continues to be tension where healthcare workers could get paid more to go do an easier job, and yet they love what they do, and it's important work what they do, and we need to figure out how to get these people paid in a way that is sustainable. So anyway, all that is sort of a macro. It's a result of the macro actions that happened in the pandemic.
Yeah, and maybe one more thing to talk about. As the volume decreased in a fee-for-service environment, as the volume decreased, providers lost, payers won.
Yes.
So payers' balance sheets really grew.
Yes.
They got in really strong positions to be able to make capital investments into what was going to be their future. And they already had a pretty good indication of what their future was going to be because UHG started their march to building, Optum way before COVID started.
Yeah.
So there was already sort of a clear path to what the future of what managed care organizations would actually look like, which would not be strictly insurance companies with actuary capabilities focusing on claims processing, right?
Yeah. I mean, the Affordable Care Act, the trade in the Affordable Care Act was we'll get everyone covered, and in return, we're going to lock you in at essentially a 15% gross margin. And that makes sense. And then United Health Group, but now a lot of people have then created a secondary business line. So they have the regulated business, and
right.
it is limited to 15%.
Yep.
But then they also have other lines of business that are outside of that regulated business. And many of those business lines are either doing back office things or they're providing care at some level.
Right.
It started with case management, really, I'd say. But then certainly Optum has expanded into lots of things that are, I think they employ the most docs of anyone.
They do, yes. And so that there was winners and losers coming out of the pandemic and coming out of those macroeconomic shifts. And I think that kind of sets up our second big trend, which is that the payer-provider dynamic, which was semi-functional prior to COVID, is just crumbling. Like that, that dynamic is dysfunctional right now.
Yeah, I think that whole way of thinking about the healthcare industry is no longer very helpful. It for a long time there were providers of care, and then the people that would review the claims and pay the ones that were appropriate, and then question the ones that weren't. And there are so many integrated systems that either started as a payer but now deliver a lot of care, or there's a few health systems that have gone the other way, that now there isn't that clear sort of a check and balance. There are many groups that have built up operations on both sides. And as you said, I don't think there was any intention in it, just the way that the situation evolved, the payers were able to gather financial and operating strength during this time, and the health systems were not. They were running around trying to save lives and keep the lights on, and they didn't put a lot of money away for the future. And that then has allowed the payers to really invest in this new thing. We kind of made up the term payviders.
Not we, but
we have
as an
started
industry.
using the industry has made up. We've started referring to it as a way to have something to talk about. I think that has been a place that has gotten a lot of steam, a lot of investment, a lot of traction. And there were some examples before COVID, but the significant investment and where it's gone sort of nationwide and has a lot of power is post-COVID, really.
Yeah, and it makes sense insofar as the payer-provider dynamic that existed before, which was, largely a pretty antagonistic negotiating model, around who had more leverage, who had more access, more data around the community, and therefore could sort of determine the prices, but everything really being fee for service. And, really the health system largely just sort of aggregating a body of codes, but then having a bunch of subcontractors, whether it be physician groups or, just all sorts of data providers that they're sort of working with, and they all pay them all out. That entire fee for service model, I think, became insolvent in the post-COVID, post-Fed, action world. It literally, you just can't make the numbers work in that model for most. I mean, there are a couple where you can sort of make it work. We always talk about HCA. I think you have to, because they are best of breed of their best of breed of that model, right?
Yeah, they're the exception that proves the rule. I think that, and maybe there's one or two others that we know, but in general, I mean, listen, I think it's similar to our legal system, right? Like we believe in this idea that the truth is best found through two sides sort of fighting at each other, and that gets to a fair outcome. And I believe in that if both sides are equally armed and sort of have the right incentives, and you can get to sort of a reasonable negotiated truth or reasonable outcome, and the payer/provider sort of check and balance worked for a long time. But after COVID, I don't think the providers have enough power. And then simultaneously, a lot of the payviders now are on both sides of the ledger. And so it's just not functional anymore. And I don't mean that in a derogatory way, just it doesn't work. And so we have to figure out a new way. Unfortunately, humans, especially when their job is at stake, will try to contort themselves to believe or to tell other people or to try to pretend like the way that they are functioning is still going to be okay. And so that has led to a bunch of stories that we've covered where some healthcare entity is not really delivering care to the patients in a way that engenders trust. And I think it's because they're trying to protect this old way of existing in the world in an environment where that's not going to work anymore.
Well, they don't have a bridge to the new way.
Yeah, right. There's no way to go.
Yeah,
exactly.
There's no bridge for most providers to the new path.
So the lack of trust, I think, it stems from that. Like they're sort of just trying to figure out some way to get through the day, the month, the quarter, and that doesn't work that well.
Yeah, and what I'm about to say is not a perfect analogy, but you kind of think about the difference between the public markets and the private markets, right? The public markets have a single value that capital is there to express, which is growth, right? Growth and safe growth, right? If I put $1 into a stock on the public market, I want to know that year over year, it's contributing to my overall index fund in a very predictable way, such that when I retire or when the pension fund that's invested, everything is where it should be, right? I'm getting the kind of growth that I'm supposed to get. The public markets are not a place to innovate. The public markets are not a great place for most companies to fundamentally change the way that their business works to navigate some massive macroeconomic, headwind. The public markets will simply say, oh, business, you've got a massive economic headwind. We're going to lower the price of your stock because I'm going to shift my money out of your company and into another company that's winning. Whereas on the private markets, it's much more patient capital. It can be much more strategic capital. It can be much more aligned with saying, hey, we're going to take 2 or 3 years and we're going to figure this out. We don't know where we're going, but for the next 2 to 3 years, we're going to figure it out. And I kind of look at the payvider model as much more of kind of like a private capital model, whereas the payer, they're collaborating with the provider and saying, hey, how do we align incentives in a way that we know we're not going to get exactly the result we want in month 1 or month 2, but by month 24, how can we get to the place where we've replaced this old model entirely and the savings and the, patient outcomes are significantly better? You just can't do that in this payer provider fee for service, separate negotiated model. It's very difficult. It's very, very difficult to do it.
Yeah, I think that makes sense in the public-private analogy. I'll also say that, there are a lot of values that are useful in a nonprofit. Okay, like you can build a culture, you have a mission, you're really trying to make a difference. One of the things you really can't do is retain earnings.
Right.
Like you're not allowed to have sort of retained earnings and sort of build up capital. So whether you're private or public, you have to pay out all the money every year. And you can play some games like by building real estate, but it's limited.
Yeah.
Right? Where if you are in a for-profit, you're allowed to do that. Now you pay taxes, so that the downside is you get that sort of tax on your earnings every year. But you have the ability to take a longer view and retain earnings because, well, I have these projects going on, and if I have success in this first pilot and I want to expand into 6 states, that's actually going to cost me more money to sort of invest and build that up. It's really hard in a nonprofit to do that because you have to do it like in the current year with revenue or donations or something else. And so that is it just is a disadvantage in this kind of innovation. And I agree with your public-private, but then also if you go to the nonprofit side, that they don't have that kind of balance sheet strength because they're not really allowed to keep it.
Yeah, and then let's also say the final thing around the difference between the for-profit and the nonprofit. The for-profit is there to serve the shareholders.
Right.
Now the leaders of those organizations will say they're there for their communities and they're there for the patients and they're there for their workforce. And I'm not saying that that's not true. I'm not saying that's not true. But on a quarterly basis, when they get on that earnings call, they're not speaking about that, or they're not talking to that audience, right? They are talking to their shareholders, and they're talking about the guidance and whether or not they met the guidance or they exceeded the guidance or they missed the guidance, right? That's ultimately what they're doing. Whereas in the nonprofit world, I think the priority and the first principle is to be a servant to the community. I think it really is ultimately that. And if you do that in a way that loses money, sorry for you. And that's why, generally speaking, you're going to see nonprofits that have worse payer mixes, right? And that's just a fundamental difference of the business model. Again, when we talk about the payer and the provider mix-up is, imagine having a suboptimal payer mix and also having no embedded payer. I mean, It's just a real path to insolvency. Yeah,
and then the other thing is, I think if you are operating a very large payer, right, you're in a regulated business model, and you are locked in at a set amount. Now you can grow your overall book, and then the 15% becomes more.
Yeah,
but there's a lot of incentive, and I think shareholders fully understand we're going to invest in these other areas that have much more upside, and now we're diversifying that, and it's an easier story to tell than from the other side. A health system doesn't have that sort of steady but not very profitable. Not that you can't make money at 15%, but not very profitable core. And so they don't have that same shareholder incentive to sort of aggressively find new places to build.
Yeah, and it changes the way that you strategically look at the payer part of your business. The payer part of your business becomes a strategic tool to design superior provider models that you then only deliver within your own brother or sister business unit.
Yeah.
Right. I mean, it's a tool in that case. And look, partially it's a competitive tool, but partially it just makes sense because you're gonna be aligned. You're gonna have the shared culture, same vision, shared resources, much lower barrier from a cybersecurity perspective. There's both sort of a competitive aspect to it, but there's a practical aspect to sort of being all sort of on the same team and having that payer and that provider on the same house.
yeah, you could align interests in just a much better way if you're all kind of under the same flag. And I'll say that there are certainly people that use the sort of understanding of the providing care space to negotiate in let's say aggressive ways. But I also would say that the payer's job, right, is to figure out, like, adjudicate claims. What is an appropriate way to treat these patients? And if you are delivering care in a more effective, less expensive, patients happier, the providers, the people giving care are happier, and it's better for shareholders, all of a sudden now, like, I don't want to pay these claims that are much more expensive, and the workers aren't happy, the patients aren't happy, and so you start denying claims, I think, somewhat correctly, because it's better for the patients, it's better for the workers, it's better all around, and that's not an evil intent. That's sort of their job to do.
Right.
And so as you start to gain experience and sort of an understanding of the providing care side, I think there are times when groups used sort of their market power, maybe in a way that was challenging, but there are other times where they just learned, gosh, we can do this a lot less expensive. We shouldn't now approve these claims.
Right. So this second trend of the payer provider dynamic just basically dissolving, it's no longer functional, is really leading to the third and final, and then we'll get into some stories. But this third trend around this newfound insolvency that has been driven by the macroeconomic forces is creating the tailwind for defragmentation, right? And I think defragmentation is the best high level term we could come up with to describe multiple market phenomenon that are happening. One we just talked about very clearly, which is the verticalization of the payer and the provider into one organization. But also it's the rush to consolidation of health systems, right? And there's so many, I think, moral debates about whether or not it's okay for health systems to merge. For-profits shouldn't be able to buy nonprofits. Merging health systems kills competition and leads to higher costs and worse outcomes for patients, right? I would consider all those to sort of be, community-oriented or moral debates. And quite frankly, they don't fully appreciate the insolvent situation that the old state healthcare industry is in today. It's just not working. It's not, it's like if they don't do these things, they're going to go out of business. They can't keep going. So I think consolidation is another one. And then in some cases where consolidation is not an option, things are literally just going to go out of business. And that's going to be another, form of market phenomenon that we can package under this defragmentation bucket.
Yeah. I mean, I think the two of us and most people in healthcare, like, you're in healthcare to try to make a difference. I mean, you want to make money, but you're also trying to help people. It's a care industry, and me, and I think a lot of people becoming aware that the old models of a siloed care delivery system, and then relying on payers to fund it, is not sustainable. And then the fear that I had, and a lot of people have had, of consolidation and what would that mean to people that need care and maybe can't quite afford it or need a certain type of care. I become less fearful when I start seeing all of the mistrust and challenging things that the established systems are doing. So it's not sustainable, and in their sort of reaction to try to protect the existing systems, they're not always making the best choices. And so that leads to an opportunity, I think, for someone to say, well, let's defragment this, let's align interests, let's all come around and try to bring care to these people in a way that is aligned and delivers better outcomes, and then can pay people in a nonprofit or pay people and have earnings in a for-profit either way.
And not go out of business.
And not go out of business. And it can be sustainable for several years.
Right.
And that pressure from the macro forces, which I don't think is anyone's fault, but just has led to this situation where all the established systems they need to figure out a way to join up or figure out to get involved in a defragmented solution where everyone can be taken care of in a sustainable way. And that, I think, that loss of trust, right? Where I don't trust that the health systems that are not connected to some kind of payor system or have a plan for that, or they're working towards that, I don't think that they're gonna exist. And so then you have this, like melting iceberg where everyone gets more and more nervous and they take bigger and bigger actions to try to protect their thing that doesn't result in good patient care. And so that's an opportunity. I want to try to be optimistic. That has an opportunity for others to say, well, let's try to defragment this and start from first principles and bring solutions that can solve the problem at hand. Let's deliver care to these people. We need to fund it, of course. And so that's the opportunity, that it is insolvency, it's loss of trust, it's a changing of this whole system that is a little bit scary, but it's so unfunctional now. I'm trying not to say the word dysfunctional. It's not functioning well.
Right.
And that means that we have to create a new thing.
Yeah. And we were, maybe debate is a little strong of a word, but we were having a discussion where I don't think we fully landed about sort of what that defragmentation process will look like in terms of replacing the old system with the new system. And I just am of the opinion that in some cases, and this I think will certainly be, socioeconomics will be one way to look at this. In some cases, we will have replacements, right? We will have something that comes and competes and beats the old thing. And so when the old thing goes away because it loses, it's no loss to the community, to the patient, because that's great. And I think there's going to be some cases, in particular, poorer neighborhoods, poorer towns, where the defragmentation is going to result in something just going away. And maybe in the future there will be something to replace it, but I don't think there's a guarantee that things get replaced. When all these Rite Aids go out of business, there's no guarantee that something comes in and replaces that Rite Aid, right? And whether or not we think that Rite Aid is necessary, that's a objective thing that it's a judgment call that maybe we can opine on, but it's not fact. Whatever we say about that is not fact. What is fact is there was a Rite Aid there. There is now no longer a Rite Aid. And if there is not another point of care that replaces it, the people in that community who may already be challenged from a transportation perspective or many other perspectives will have to find another site of care, and that site of care could be further away. That could lead to worse outcomes. That could be considered a lack of access of care. So the defragmentation, I think with all these trends, we're not trying to say what we want it to be. I think we're just trying to say this is what we see. This is what we see happening. And I remember, Vic, when I first got into this industry and you were teaching me a lot about it, and then I was learning from lots of other people in Nashville, many of the things we're talking about in these trends were the things that people said were kind of laws of physics of the healthcare industry, such as healthcare is so fragmented. It's such and that was true.
Yeah.
It's such a fragmented industry. That was true. B, I think a lot of people in Nashville made a lot of money off of that fragmentation, right? Off of how many different split parts it was broken into. I mean,
the whole DRG family tree thing was fragmenting.
That's right. A ton of money was made in the fragmentation, and it's just not going to work any longer. Like, that's not going to be a long-term sustainable thing. Now, is it gone today? It's not gone today, but we are clearly in an era where health systems are working very, very hard to combine, to merge. They're even finding creative ways to do it that aren't necessarily an entire merger, like what happened in Michigan with Henry Ford and the Ascension Michigan Hospital, right? Like, it's more of like a joint venture. Is that a model that will be more acceptable to the FTC and to the AGs,
regulators
and things like that, right?
Yeah,
exactly. So, but they're trying to find ways to defragment, right? To combine, to partner, because unfortunately, staying separate and staying on your own and staying small, it's not viable.
Yeah, I mean, I think I agree with that completely. The defragmentation process and economic progress in general is not fast, and it's not spread out evenly, right? So Nashville, we have more hospital rooms than probably any city our size in the country. Nashville, I think, will always have good care. But that's not true for every city. And this process is going to be lumpy. There's going to be places where there's a great new solution, and then right across a state line, there's not a solution.
Right.
And I think I don't want people to suffer. Okay, so like in general, healthcare is so personal and emotionally fraught. I don't want people to suffer. And yet I think you're right. The only thing we can do is talk about what we see and try to be honest about it.
And you and I specifically can invest in solutions. We can actually try to innovate and create solutions.
We can try to bring solutions that help one small thing, or maybe a few things that fit together, or maybe it's a bigger thing. But that doesn't mean there's not going to be people that suffer in this transition. There will be people, but I think there are people that are suffering in the existing system today.
For sure.
We cover these stories. I mean,
these stories.
There's stories every week. We can't cover them all with people that are suffering and the existing system isn't delivering care for them, or they work in a system and they're getting verbally abused, physically abused. And so I don't think we're saying that defragmentation is going to be without suffering. What I think we're saying is this is the future, and the future is coming much faster than I thought 5 years ago. That doesn't mean it's going to be here in 3 weeks, but it's coming a lot faster
right now.
It's coming faster. Like, so I think in 3 months, in 3 years, there's going to be serious swaths of the healthcare industry that are defragmented and have whole new systems.
Yep.
And will that be better for every person? I hope so, but probably not. There'll be some people that would have been better off in the old system. Hopefully, in the mass, more people are taken care of more effectively in the new systems. But it's never going to be perfect. I mean, it's healthcare. People suffer. Unfortunately, people die. And that's the only system that we can build. And so I don't know. I think there will be, I mean, Rite Aid's a good example. There'll be Rite Aid stores that close, and those people will have to go further. They won't be able to talk to a pharmacist as easily. They'll have to do some kind of rideshare thing or be on a telehealth thing or something. And it won't be as good as walking into their neighborhood Rite Aid. And maybe there'll be a solution that comes up that eventually is better for most of the people. But that's the best we can hope for. I think that's the only thing we can do.
That's right. Yeah. So, I mean, look, if you take issue with any of our trends, like reach out to us, let us know. I mean, this is just sort of the way that we saw this all breaking down. And it's, I mean, even looking at like the General Atlantic thing, right? I mean, if you look at the strategy there,
General Catalyst?
General Catalyst. Yeah, exactly. If you look at the General Catalyst thing, look at that strategy versus what a healthcare VC strategy would have been 5 years ago, right? I mean, to me, that is an indicator that they think the defragmentation is actually going to create less opportunity for, non-platform companies to sell into and to be acquired by, right? I mean, they're literally building a health system because they're not sure that health systems are going to buy their tools.
Yeah. I think it's both ends. I think they're trying to build I'd call it a full stack healthcare delivery system.
Yeah.
They have everything, right? They have primary care, they have diagnostics, they have all the back office, they have the health system, they have the clinic, they have the ED, they have the surgery suites, they have ICU, they have the payers. Their vision, I think, is to have the whole full stack delivered. And whether they can pull that off or not, I don't know, but it's almost time. It either is like right now the right time, or they're a year or 18 months early. But as a VC, I mean, that's the risk you want to take.
That's right.
Because like heads, I control this multi-billion-dollar platform, and tails, I lose the capital I put in. So like I'll take that. I'll do that bet 10 times.
Right.
So then the thing I want to just mention is I think I'm seeing that there's going to, defragment the entire population all at once. I think there'll be segments.
That's right.
So maybe there's like certainly there's a Medicaid segment for the population that it really is government supported. There's a different reimbursement structure for that. Then there's the commercial sort of a working age people segment. And then there's, I think Medicare Advantage seems like the dominant retiree platform. There may be other segments. That's where audience listeners may help us, fine tune that. But it seems like we might have entire segments that you could take over. But I don't know if one group's going to be able to do all the segments, or you might do one and then start to expand into other ones.
Certainly when it comes to Medicaid, everything that I've heard from state Medicaid directors is you really have to design for Medicaid first. And so I think you're right. I do think those market segments.
Yeah, Medicaid is pretty different.
It's very different, right? So I think you're really going to have different teams, different strategies, different sort of capital allocation models, quite frankly, going after those different market opportunities. And that is good for us as capital allocators and innovators, that there will at least be that level of complexity when it comes to the market segments.
Yeah. So I'm kind of excited about what I think we've uncovered in the last 24 and a half episodes. It's pretty interesting to see, like, we're going to seek to keep trying to understand the macro forces because they're driving everything. And then how is the existing system fraying? Where is it really in need of desperate replacement? And where is it holding on? And maybe that's not the first place that we change. And then what we want to find as VCs is what are the innovative new solutions? How can we begin cobbling together things that make a difference?
Yep.
And so that's part of the optimistic side of this.
Yep, absolutely. Okay, it's a good time to take a break. Let Doug share a little bit about Jumpstart Foundry, and then we do have a couple of stories we'll break into before we sign off.
Thanks, guys, for the opportunity to talk about our pre-seed fund, Jumpstart Foundry. My name is Doug Edwards, CEO of Jumpstart Health Investors, the parent company of Jumpstart Foundry. We're so excited to be able to talk about early stage venture investing, certainly the need for us to change the crazy world of healthcare in the United States. We are spending 20% of our GDP, north of $4 trillion a year on healthcare with suboptimal outcomes. Jumpstart Foundry exists to help us find and identify and invest in innovative companies that are going to make a difference in healthcare in our country. Every year, Jumpstart Foundry invests a fund, raises a fund, and deploys that across 30, 40, 50 assets every year, allowing ease of access for our limited partners to invest to help us make something better in healthcare. Some of the benefits of Jumpstart Foundry is there's no management fees. We deploy all the capital that's raised every year in the fund. We find the best and brightest, typically around single-digit percentage of companies that apply for funding from Jumpstart, and we invest in the most incredible, robust, innovative solutions and founders in the United States. Over the last 9 years, Jumpstart Foundry has invested in nearly 200 early-stage, pre-seed stage companies in the country. Through those most innovative solutions that Jumpstart Foundry invests in, we also provide great returns and a great experience for our limited partners. We partner with AngelList to administer the fund, making that ease of access not only with low minimums, but the ease of investing in venture much better. We all know that healthcare is broken. Everyone deserves better. Come alongside us with Jumpstart Foundry, invest in making the future of healthcare better and make something better in healthcare. Thank you, guys. Now back to the show.
All right, we're back. My buddy Nick, our buddy Nick, was talking about traveling to the Universal theme park, and he was like, dude, everyone keeps talking about the economy is no good, but these people are just, the place is packed and people are spending a ton of money. And, we all were just like, yeah, it does seem like people are spending a lot of money. And so the GDP numbers came out for the third quarter, and lo and behold, the GDP grew almost 5%, 4.9%.
Yeah. Yeah, it's incredible. Way above the estimates. I was not expecting this. I knew it would be positive, but this is like a blowout GDP number. And I agree, travel has been, every time I'm traveling around, every plane's full. And and yet it doesn't feel like my friend group and people I talk to, there's not a lot of like people saying like I'm killing it and like socking money away. Like
No.
people are still struggling and complaining about the cost of stuff. And so the economy is growing at 4.9% in the third quarter, but it still feels like we're not don't have tons of momentum going into the fourth quarter.
Yeah, I mean, the consumer has not been broken yet. Okay,
Yes.
I think we can say that.
Yes.
The Fed has not broken the consumer
Right.
yet, and therefore inflation will still grow. So in the personal income category, there's sort of three things that the Bureau of Economic Analysis that they focus on. One is current dollar personal income that did increase, but the increase was down from the second quarter. So 199 billion in the third quarter compared to an increase of 239 billion in the second quarter. So that trend is down. Disposable personal income increased 95.8 billion or 1.9%, but the real disposable personal income decreased 1% in contrast to an increase of 3.5%. And then personal savings, this is a big one, was 3.8% in the third quarter compared with 5.2% in the second quarter. So what we have is a tale of two stories here, right? Which is one, consumer spending, which was the largest category of GDP growth in the third quarter,
Right.
was off the charts. And yet actually the household is doing worse, did worse in that quarter. And so that's where you start to sort of see the credit card debt going up, and generally speaking, people not being able to change their habits, even though financially they're not doing as well. They're not able to save enough. Their income is getting a little bit better, but that's even softening, right?
Yeah.
But they're spending like they're killing it.
Yeah, we have this is not a data, solid position. My gut feeling is that we all have gotten used to a certain lifestyle, a certain spending rate, and we're still spending at that rate and hoping that something will happen. And whether that's another government stimulus or the Fed starts stimulating again or something, I don't know, something will happen, and you only live once, I'm just going to keep going. And yes, credit card debt is getting to a level that is pretty scary. And it just feels like we're doing everything that my grandmother told me not to do. That's not a scientific analysis. It just feels like we're spending a lot, and that comes through in the GDP number, but it doesn't really seem like it's that healthy of an economy.
So sort of two things I would say. One, that lack of congruence between how people are actually doing versus what they're spending does feel recession-ish. It feels like over the hill, maybe in Q1, we actually are finally going to get to that recession that everyone's been talking about.
I don't even know if it's that long. I think Q4.
Could be
I'm
Q4, huh?
Q4,
Could be Q4, okay. And then the second thing is that we're probably going to get another rate hike.
Yeah, that's right.
Probably get another rate hike, right? All right. So next story I want to go to is Charles Hudson, who's the general partner at Precursor Ventures, which is a seed fund based on the West Coast. Has been writing a Substack called Venture Reflections. I've been kind of keeping up with what he's been writing, but he absolutely crushed it with his last entry that he published on October 25th. The title of the entry is "The Big Reset in Seed to Series A Graduation Rates is Real and Permanent." Now, I know not everybody who listens is a VC, so you may not know what graduation rate is. So let's just sort of explain it really quickly. Sure. Graduation rate is, Vic and I invest a lot at the seed stage, right? So we're writing, $1 to $3 million checks, and the companies are valued somewhere between 10 to 20 million. Okay. We want those companies to do really, really well, but we also would like for them to raise another round of capital from a different VC who is not the two of us at a higher valuation and get a bigger check. That whole process is what's called a Series A round. Okay. Yeah. And if a company that we invest in at the seed stage gets that done, that's considered graduating. They've graduated from the round that we invested in to that Series A. Okay. So that's a pretty good explanation, right?
Sure.
Okay. So the reset that Charles is talking about here is graduation rates from seed to Series A were pretty high for most of the last 10 years.
Yeah.
And that
you had to really screw up.
Yeah. Yeah. But there was plenty of Series A capital out there. It was kind of all over the place. Okay. And he is sort of saying anecdotally, I don't think this is backed by any Carta or AngelList data, but he's saying anecdotally that to him it feels like deal volume from the seed to Series A graduation perspective is off about 75%. And I will say, as a seed stage VC, I certainly feel like that's about right. That number feels like that's the kind of collapse we've seen in the Series A space. Series A investors are not on the front lines. They've been off the front lines for more than a year now. It started last summer, so it's gone more than a year, and they just don't feel like they're in any rush. And I think one of the things that he points to is that so many of these Series A funds were so big that they raised these, $300 million, $400 million, some of them $1 billion Series A funds, that in order for an exit to make sense for them, it's got to be $1 billion exit.
Right.
And a lot of these seed deals, especially in this new economy with the way valuations have gone down, they're just simply not going to get there. They're not going to get to $1 billion exit, okay? And that means, well, I'll just hold on to my capital until I find something that does get there. And that is really changing the landscape of early stage companies in a way that we've been talking about for more than a year. We've been telling founders about this for more than a year. Yeah. I do believe most of the founders I talk to now get it. Certainly the founders in my portfolio get it. I mean, they've lived through it, so they get it. But the point that Charles is saying is that this is not just a blip. This is a reset that is going to be durable, likely permanent, at least permanent in the context of the funds that we are managing, right, which have 10-year windows.
Right.
So for the next 10 years, you can kind of expect this is the way it's going to be. And seed stage companies are going to have to be really capital efficient and may never get another round of capital. The seed round may be the growth round.
Yeah.
That's insane. But I agree with that.
Yeah, I agree with that too. I think that's right. And so I agree. This was a really well done article. I think he's exactly right. My belief is that a lot of Series A investors have their own shit to deal with. Like they have a portfolio that is challenged. Mm-hmm. They're trying to figure out their own stuff. And the need to invest in a new company is like the last thing that they're worried about right now.
Right.
And so, yes, they have dry powder. They'll probably do a deal eventually, but there's 1,000 deals out there, and I got to take care of my portfolio I have in hand right now. The later stage, B, C growth is really gone because they are so tied to the public markets, and the public markets are in trouble now. And so it kind of all flows down, I think, from the public markets. The other thing that I think he wrote about that is really interesting because it's exactly right is, and we were sort of just playing around with Jumpstart, the accelerator, and trying to learn about this stuff. But the cloud came out, the iPhone came out. Like there were all these tools and thing called Lean Startup, where like you could do a startup and really work with your customer to not waste a lot of money in products that weren't going to be useful.
Right.
And that kind of iterative process, the development tools were such that you could be in the cloud and design and develop pretty quickly. All that kind of came to life 2000 to 2008 or so. And we were playing around with that stuff then. And the entire existence, when I started in 2001, there were no seed funds. It wasn't a thing.
Yeah, right.
There was angel investing and A.
Yeah, well, for good reason. There was no cloud.
There was no.
You had to buy servers.
Yes.
Put them in a data center.
Yes.
That was expensive.
You needed to raise $30 million.
That's right.
And go.
Yeah.
And the entire seed concept was we can get a lot of progress done. We can get customers. We can get revenue. We can really get product market fit. We can start having earnings and build out our business model and grow. And the point he makes that I think is really great is, and I'm doing this right now. I have a new fund. I'm trying to invest in 10 seed companies that never need money again. And I just closed one today. We put money in. They will never need money again, knock on wood. Now, they might raise money, but that doesn't mean that we're building a tiny little sort of business that's not going to grow. It needs to be able to grow at serious rates, 50, 70, 100% a year on internally generated cash. And you have to have a really capital efficient business model and be really good entrepreneurs to pull that off. That's what seed funds were supposed to do, and be able to sort of build all this value and then go to the A with like a very strong, or maybe even skip the A and go to a later stage fund. That was the basic concept. And then the great financial recession, whatever thing happened.
Yeah, GFC, Great Financial Crisis.
Crisis happened. And so that distracted everyone, and sort of free money came in and zero interest rates. And all of a sudden there was money everywhere. And so seed funds were not that. They just were sort of like a beginning, early A.
They were just deal flow.
Yeah. Serve deal flow to the A rounds. And I think we are back to where we started. You and I need to build companies that are self-sustaining and can be $500, $800, $1 billion without ever raising an A round. And that's really hard.
Well, the thing I like about all this is that was our premise when we started all this.
Yeah, right.
So
right.
I mean, I feel at home.
Yes.
Here. This is
It's
home.
a lot easier for you and I than the money. Let's just throw money, and it's a momentum thing. I'll talk to my fraternity brother and we'll get it funded.
Totally. Yeah. No one ever gave us any money.
Right. And we don't have that sort of golf club membership, Ivy League business school thing. We don't have that.
Yeah. So I mean, this is fantastic. I just want to read this paragraph because it kind of encapsulates everything you just said.
Yeah.
Right. With the era of capital abundance coming to an end, the stage might finally be set for the era of the capital efficient seed stage company. Seed stage startups are likely to confront a world in which raising Series A rounds of investment remains difficult for quite some time. There will be a premium on execution and doing more with less capital. The necessary pieces might finally be in place to push companies back towards the hoped-for levels of capital efficiency. It's awesome.
Yeah.
It's awesome. Let's do it. I'm ready. I'm ready to do this.
And, important, great things are fucking hard. So, I'm not saying it's going to be easy, but building a company with very little capital means you control a lot of it.
Well, I'm just tired of arguing with founders saying they need $20 million when all that really means is you're not willing to make hard decisions and focus on priorities and not spend capital that you don't have to spend. Yeah. I'm glad Absolutely. We can stop having to have that argument and really dig into you have less, now what? Like when you say when you say you need, are you going to give up now?
Right.
Like is that what it is? And those who will should.
And then the other thing he says that on the front end, he's talking to us basically. VCs need to be clear with the companies on what the plan is.
Totally.
And at least for companies I'm funding, the plan is not let's sort of pretty this up and then raise $20 million in 6 months. It's let's execute and let's build a business that we can be owners of for a long time.
I did 4 less deals in Nova Fund 1 than I thought I would in the beginning.
Yeah.
Because I was like, ain't no graduation rates.
Right.
Right. So I gotta, Catherine and I need to be the backer.
Yeah.
The foreseeable backer.
Yeah.
That's
you will own more of a smaller number of companies.
Yes.
You'll own a higher percentage
Correct.
Of fewer companies.
Correct.
And the entrepreneurs and management teams will own more.
Correct.
And it has to work.
That's right.
And if it does work, that'll be great. Yeah.
That's great. And generally, I think we need a higher hit rate because without the capital, unicorn season is over too.
Well, positive cash flow helps hit rate.
Yeah, exactly. I mean, all these things sort of move in the direction of what we always wanted to do. So I think this is
And awesome. I think it fits well with healthcare.
I think it fits very well with
healthcare. Is not as amenable to that sort of like get to a unicorn status in 6 months kind of thing.
Now, the thing that we will have to figure out is what does all this mean for scientific discovery in healthcare, right? What does this mean for the biotech space? What does this mean for the serious diagnostic space? Because those are spaces, because of the regulatory pathways, which are going to get even harder based on developments in the FDA. I'm sorry, you need the capital.
Yeah.
Right.
Oh, yeah.
And maybe that's what we do. We just sort of, draw a bright line and say, there are the companies that need the capital because they're really, at the end of the day, science developments.
Yeah.
And then there's companies that don't need the capital, and we're just going to allocate the capital to the companies that need the capital.
Yeah.
And not to the ones that don't.
Yeah. And I was talking with Emily Evans, who's a friend of the pod. She's been on here before. I was talking to her yesterday. The scary thing in biotech is NIH funding is drying up.
I know.
And so, like, without basic science being funded, that's the more worrisome thing on the biotech side. We have never invested in biotech because I'm not smart enough to know biochemistry. But
had a whole conversation about biotech and how I just don't feel good about doing that. We did it once. I'm not going to be doing that anymore in the near future.
Just like, I mean, I'm all about risk mitigation, right? So, like, putting a new molecule into the human body is just hard to understand what's going to happen.
Yeah.
So,
I mean, that part, I can actually stomach that risk based on a lot of good data. It's the capital market part is too hard. That's the part where I'm like, oof, you're so dependent on the capital market and not on great execution.
Yeah, and
that part's really tough for me.
Without the government subsidizing the basic research, I don't know that the model really works that well.
Yeah, that's the hard part. All right, two more quick stories. One, Meta was sued by 42 attorneys general alleging Facebook, Instagram features are addictive and target kids. So a couple things about this. One, this seems to be very in line with what our Surgeon General has been kind of calling for, which is a moment of accountability for social networking platforms. And really, there's only one of that's noteworthy to talk about, which is Meta at this point. And the fact that they've been experimenting on our youth. So I think it's so interesting that we were able to get a bipartisan group, 42 attorneys generals, that's clearly very bipartisan, to collectively sue Meta on behalf of, America's children.
There's no question they do this. It's true. I mean, it reminds me of the cigarette litigation. Like, Meta and I think TikTok is also in the crosshairs. So those are the two big ones in my mind. Maybe Snapchat. They attract kids because then they have a customer for life and they can sell ads to them forever. And it's highly addictive. I mean, it just is highly addictive. And I think Facebook's doing a lot of good things. Meta's doing a lot of good things, but they have internal documents. I mean, they know this. That's why it's like cigarettes. Like, there's internal documents. We've both seen the documentary. I mean, there's
whistleblowers.
There's lots of lots of whistleblowers. It's going to be a hard case for Meta to work through. But we have all of these kids addicted to social media, and so there's going to have to be some. I don't think you can turn it off. I don't know how they turn it off. So I don't know where this goes exactly, but it seems true.
Yeah,
and it's good that, I mean, of the things for states' attorneys generals to be working on, bipartisan. I mean, 42 states is almost all, obviously,
it's meaningful.
Most of the states.
It's meaningful, and
it's in line with the Surgeon General, and we all know it's true. So whatever controls, like, if you're not 18, you shouldn't be subject to the same thing that an 18-year-old subject to.
Yeah, I don't see any way that this does not result in some change to the way that Meta operates. I just 42 attorneys general. That's a lot. That's a lot. Yeah. All right. Final story, which is a hard one. It's a story from the New York Times. The name of the story: stabbed, kicked, spit on, violence in American hospitals is out of control. So anyone who's been inside of a healthcare facility since the pandemic has seen signs. You've seen signs that are posted up that basically request that you are patient and that you remember that healthcare workers are people too, and that they're under a lot of pressure. And then they, if you read the fine print, they kind of say violence of any form will not be tolerated, right? And I've seen these in all sorts of different health system facilities, right? So I won't name names, but everyone that I've been in recently has these kinds of signs up, right? it is an absolute disgrace that our healthcare workers are having to deal with, this kind of abuse, mental, emotional, but worst, I'm sorry, physical abuse. Yeah. It's a disgrace. It's disgusting. And it's just a disintegration of the fabric of our country, that this is something that we're doing to our friends and our family members and our communities, to allow this to happen to the caretakers. It's just,
the video is really hard to watch, and I would encourage listeners to watch it anyway, because it's really important. What I would say is that our emergency departments should not be the place where mental health first goes. They're not designed for that. They're designed for trauma and, emergent issues that are medical health related. Now, maybe it's hard to determine always, but they have become sort of the catch-all area for anyone that is struggling or in distress or in behavioral health crisis. They go there. And that's not fair to the workers there. And they're not suited to deal with that. So I don't know. This is one of the ways that our existing system is not functional. It's not working.
Yeah. And, I think the article does a reasonably good job of talking about some of the inefficiencies and some of the challenges in the experience, just sort of the mismatch of, it's an emergency department. People are going in there because they're panicked. Often when people go into the emergency, it may or it may not be an emergency. A lot of times people are going in there to figure out whether or not it is an emergency, right? But they're certainly panicked. They're not in the best emotional state. They're often not in a very good physical state to sort of be there. And as you already said, some people are dealing with, chronic mental health issues who are entering these environments. And so the stress can be relatively high for all of those reasons. People who work in the emergency department, they're well trained on how to deal with all those things, but they're not perfect. That they will make mistakes, but it can be a bit of a pressure cooker, right? There is just a reality to the environment that can result in tensions being raised, being elevated. Sometimes there are wait times. You get in, you get triaged, you get to a room, and then maybe you see an initial nurse who sort of gets you set up, and maybe you don't, maybe the doc doesn't walk in for an hour. I mean, that happens. That happens in EDs around the country on a regular basis. So I think they do a good job of sort of talking about some of the operational functional challenges, both in terms of the nature of the work that's being done there, and then some of the, delays and things in the experience that can, create environments where people may be more prone to outbursts. Having said all of that, violence against healthcare workers is just fundamentally unacceptable. I said all of that just to say, you can see how in this environment there may be, a higher likelihood of this happening, and still it cannot happen, right? And still it cannot happen.
Yeah, exactly. I mean, these people are doing a really hard job for not that much pay in some of the hardest environments in the country, and they don't deserve that. And now, yes, every situation, someone might be under a lot of stress and have their own mental issues going on, and there's family dynamics, there's all kinds of complexities, and there's no reason to punch a medical worker. There's no reason to be verbally abusive of a medical worker. It just can't. It's unacceptable. I agree.
Yeah. So
how we solve it, I don't know. That's the issue. It's this is going on, and we need some solution because it's not okay.
Yeah. So this is definitely one of those stories where it's hard, but we would definitely encourage people to read it and just be aware of what is happening in your community. You've got an ED. You've been to the ED. Yeah. I have friends who are emergency doctors. Some of my Aspen fellowship. A guy who I do jiu-jitsu with is an ER doc, and
it's the place that cares for you at the lowest point in your life, typically. And
every time I've ever been to the ED, I've been really scared.
Yeah.
Right. Otherwise, I just sleep it off and go into urgent care in the morning.
Right, exactly. Otherwise, you wouldn't go there.
That's right. Yeah. That's right. So, so shout out to the ED docs and nurses and staff and hopefully we find ways to protect y'all.
Yes.
All right, that's it. Great episode 25. Vic, thanks for the work on the trends. I think it was a great idea, and hopefully this will sort of serve as a framework. And over the next 25 episodes, maybe we can develop the next set of trends. You know?
Yeah. Hopefully we'll see some exciting, new, optimistic solutions that we can bring.
Yeah, and listener, like, subscribe, share. Please share the show. Honestly,
this is actually a good one to share because it summarizes a bunch of things.
Totally. I'm very convinced. I know people who listen to the show on a regular basis and reach out to me about it. I think the way the show is going to get grow is going to be through word of mouth. You know what I mean? Because it's, the topic and the subject matter that we're talking about, it's never going to be like a super mainstream show. We didn't build it to be a mainstream show, but we do want to continue to grow it to people who are interested in healthcare innovation, right? Especially people who, we love our listeners who are in the actual healthcare industry and are curious because they want to learn more about venture and investors and sort of the mindset and the way that we think about things. And for sure, healthcare founders and maybe healthcare VCs, but healthcare founders, should be listening to the show. I'm sorry. I think we do a pretty good job of laying out the landscape for founders.
Well, it gives you a little more insight into how to maybe design your business model or how to tweak something. And every little advantage is critical in doing a startup.
Yep.
Yes.
Awesome.
Pass it around.
All right. Thanks, man.